Hey, good morning, Rhea.
Good morning.
Just me and you so far, huh?
I know, weird. I guess it's Friday.
Looks like you're doing pretty good in this class, huh?
Oh, yeah, trying to. I think chapter 7, I need to go back and review again.
Yep. We're going to have a good review on that when the time comes. The bank reconciliations can be a little bit tricky.
Yeah, I think I was getting confused on that process.
We'll get back to. Hiya, Mark.
Hello, Professor.
Getting ready for cross-country season?
Yeah, just like barely starting the preseason, yeah.
All right. All right. Wait another minute, maybe, huh? See what kind of crowd we get here. We're going to chapter 11. All right, I guess we'll get started, okay? Chapter 11 is about purchases. Chapter 10 was about sales. The chapters are reciprocals of each other. What we called a sales discount in chapter 10 becomes a cash discount now. What we call the sales return and allowance, that becomes a purchase return allowance. Okay, hold on here. Let me get this stuff going. Come on. Share screen. You can see that, Rhea?
Yep, we're good.
All right, here we go. Today's lecture. Chapter 11, accounting for purchases and cash payments. Drum roll. Merchandise purchase transactions. Okay, like I said, in chapter 10, we were selling the product. Now we're buying the product that we hope to eventually sell for a nice profit. Purchases. In a manufacturing business, purchases refers to the merchandise acquired for resale. Must be items for resale. That's the definition of a purchase, an item for resale. And the procedures may vary depending on the situation. And of course, you can have cash transactions or more likely on account, okay? Purchases. Remember in the chapter before, we briefly went over some of the forms. We saw a sales order, we saw a purchase order coming from another company and an invoice eventually. Here, we have different flow. We have something called a purchase requisition. A purchase requisition is simply an employee asking his boss to buy something for him or her. It's typically a form that employees are allowed to fill out in the hopes they can get a new computer. You fill it out and you go to your boss, I think I'm ready for a new upgrade. And if the boss agrees, he or she will sign off on the purchase requisition and notify purchasing, who will prepare a purchase order. What's a purchase order in chapter 11 is a sales order in chapter 10. So you have a purchase requisition, which is an internal document. Purchase order, now that's the contract between you and the vendor. And then eventually the goods arrive and there's a receiving report to be prepared and you're going to get an invoice to pay. Purchase invoice. In chapter 10, that was a sales invoice because we were selling. So you can see how this is sort of a mirror of the two chapters. Purchase requisition, a form used to request something. And they're getting into detail with a 3-part form. Not going to worry about that. Just know what a purchase requisition is. An internal request for something. And it can be in the form of a printout like this. The purchase order is the written order to buy the goods. This is your contract. The purchasing department reviews and approves the purchase requisition and prepares a purchase order. And they're starting to talk about who gets copies of it. Well, the accounting department obviously is going to get a copy. The purchasing department, they keep a copy. We send one out to the vendor probably. And the copies may also go down to receiving. That's pretty typical. I've seen companies where a copy of the purchase order goes down to the receiving area, but the one the receiving people get does not have any dollars on it. They don't need to know how valuable a particular shipment is, incoming shipment. Purchase order, simply so many of these, it's so much a price. And then a receiving report. This is an important one, I think, prepared by the receiving department. And it can be a separate form. It can be created from the vendor's purchase invoice. And the receiving report will eventually work its way up to the accounting department. And what your accounts payable person is going to do, he or she is going to take the invoice that you received from the customer, from the vendor, take the purchase order, take the receiving report, and eventually, when the check is mailed, all four of those documents will be stapled together and filed away. Purchase invoice prepared by the seller as a bill for the merchandise shipped. Seller calls it a sales invoice. Buyer calls it a purchase invoice. Before payment is made, the accounting department compares the purchase invoice. You compare it to the requisition, the purchase order, and the receiving report. Did we get the right item at the right price? Checking all documents. That's another example of internal control. And there's an invoice. We all know what invoices look like. We've been paying them now for years. Cash discounts available if the bill is paid within the discount period. The seller, we called it a sales discount. The buyer calls it a purchase discount. As you remember in chapter 10, a sales discount is a contra sales account. Contra sales account, it has a debit balance and it will reduce our net income. A purchase discount has a normal credit balance, and when a company takes a purchase discount, they're increasing their net income because they're paying less for the product. Let's understand about trade discounts. In a lot of industries, there are brochures and circulars that get sent out, and these publications have a list of the prices of everything. And then it might say at the bottom of the page, 30% trade discount. This is a discount offered to the people who buy regularly from you, offered by the wholesalers and manufacturers. It's a reduction from the list price or catalog. Trade discounts represent a reduction in the price, should not be entered in your general ledger. In other words, you go into a store to buy a computer and you plan to spend $1,000, and you walk in there and you see that the computer is on sale for $800. Well, you don't record a $200 trade discount. You're going to start with the $800. That's what you bought, an $800 computer. The buyer and the seller both record the transaction at the net amount after the trade discount. Trade discount is simply,
Professor?
Yeah.
Sorry. Why would the seller not enter a trade discount on a product?
because there's no consideration between the two parties. A trade discount is simply the company doing the selling. They're saying we're taking 30% off this product. There's a product that normally goes for $100. It has a 30% discount. We're going to record it as a $70 purchase. That's what we paid for it.
Oh, I see. Okay.
Yeah, there's no value in saying, oh, we bought a $100 item, then we got a $30 discount. No, that kind of discount you just ignore.
Okay, got it.
Make
Thank
sense?
you.
Okay.
Yeah.
Purchase invoice with trade discount, huh? And this is pretty typical. Let me make this a little bigger. Here's an example of what we're talking about. Quality bike products. They went out and they sent a bill. They sent a bill to their customer, and the total of the three items was $760, less a 10% discount. Well, we, the purchaser, we bought something for $684. We ignore that trade discount. We ignore it. Here we go. Now we're getting to some good stuff. Describe and use the merchandise purchases account and the computation of gross profit. This might be the first time you're hearing that expression, gross profit. It's gross, man. Merchandise purchase accounts. Look at some of the new accounts you're seeing for the first time. Purchases, purchase returns and allowances, purchase discounts, and freight in. Purchases are a cost, has a debit balance. And remember, I said a million times, you never credit sale. I'm sorry, you never debit sales. You never debit sales, and you never credit purchases. You never credit purchases. If you return goods to your supplier, that would be recorded not as a credit to purchases, but as a credit to purchase returns and allowances. And if you take advantage of a 210 net 30 discount or something, that's a purchase discount. You never credit purchases. Freight in is to what you paid the trucking company to bring the goods into your building. Okay, that becomes part of the cost of the inventory. That gets added into your purchases. It could be simply the UPS bill, if you will, or it could be a big $1,000 trucking charge. Okay, so purchases, normal debit balance, returns and allowances and purchase discounts, credit balance, and freight in is an expense with a normal debit balance. And they're just showing you here.
I think you're on mute, Professor.
Can you hear me now?
Yes,
Yes.
How long have I been on mute?
a couple seconds. Like as soon as we got to this page.
Do I need to go back to this slide here?
No, I don't think so.
Okay, that's sorry, but I must have hit the wrong button. Okay, accounting for merchandise purchases. We were just looking at these accounts here. Purchases have a debit balance. The contra purchase accounts are purchase returns and allowances, purchase discounts. Freight in is an expense, all part of the world of purchasing. Purchase account used to record the cost of what you bought. It's debited when you buy the product, and you would never credit it, never. We're not talking about the closing process. That's something we don't consider that. And here's a simple example of a purchase. We bought something for $100. We're going to debit purchases and we're going to credit cash. That's not so hard. If the purchase was made on account, as they're showing here, we debit purchases and we credit accounts payable. We owe $100. Liabilities have a credit balance, normal credit balance. Purchase returns and allowances again. A contra purchase account, contra cost, if you will, used to record items we're returning. Normally has a credit balance. It's credited for the amount of returns and allowances, and you will never debit these accounts, excluding the closing process. Here's a little example. Company bought something on account for $200. It turned out to be defective, so they got permission to return it. Well, we don't owe the $200 any longer, so we get to debit accounts payable to reduce that to zero, and we credit purchase returns and allowances, which is a contra cost account, and thus that gives us $200 of income. And here's an example. Assume that the same merchandise is retained, but the supplier gives us a price reduction of $45. Be the same thing, We debit accounts payable for the 45. That's $45 we don't have to pay, and we credit purchase returns and allowances. Purchases discounts, contra purchase account. This is the 210 net 30 type situation. The account is credited for the discount in trying to get people to pay more quickly, and it's debited through the closing. And here's an example of the purchase discount. We bought something for $100. The terms are 210 net 30, 2% discount if you pay in 10 days. Otherwise, you pay the net amount in 30. We are going to debit accounts payable for the entire $100. We don't owe that anymore. We don't owe them anything. But we didn't have to pay $100. We only paid 98 because we took a 2% purchase discount, okay? And like I said earlier, if a company's offering 2% discounts in this era of low interest rates, you'd be nuts not to take the discount. You should be grabbing every one that's offered. What is freight in? It's an expense. They're calling it an adjunct purchases account used to record transportation. And you debit it for the transportation charges, the truck, the train, the delivery people. Let's have a little fun with transportation charges. FOB, free on board terms. I'd like you to get familiar with this. This will be on the test a little bit. FOB, free on board. FOB is simply this. It's the point in time when title to the goods passes from the seller to the buyer. At this exact moment in time, whoosh, the buyer now owns the goods and is thus responsible for any costs involved with it. And there's a whole different kinds of FOBs, but typically schools teach FOB shipping point, FOB destination, FOB shipping point, free on board. Buyer pays for the transportation charges because the buyer owns the item as soon as it's shipped. We understand that? FOB shipping point, title changed hands as soon as the item went on its way. Freight charges are listed separately, or they could be on the purchase invoice. We don't care. My company in New Jersey bought something from you guys. You have a business on campus here, and you loaded up a truck right on campus here, and the terms are FOB shipping point. And that truck left the West Campus here, and it turned right. And when it got to Loma Alta, the truck blew up and all the goods were destroyed. The driver was perfectly fine, no problem. I, as the buyer, am responsible for that. I'm responsible for all of the expenses involved because I owned it as soon as it's left. FOB destination is the opposite. The title does not change until the purchaser receives the goods, okay? Therefore, you as the shipper, you own it until I get it. So any expenses incurred in that shipment must be paid by the seller. You're gonna pay the freight. If there's a problem with insurance, you're gonna pay it. If the goods are damaged for some reason, you're gonna pay it, okay? FOB destination. I'm just going to digress a little bit. These two items can cause a real conflict between companies. A lot of companies say, look, I'll buy from you only if it's FOB destination, because I don't want to have to worry about goods that I haven't even seen yet. Why should I be responsible for stuff that's on the way to my factory? Whereas I worked at a place where cash was tight, but we had the ability to borrow against our accounts receivable and our inventory. So when we were short of money, I would call the guy in Oklahoma and tell him to put a rail car on the rail and get it going. And that was worth about $100,000. I was allowed to borrow 75% of that. So in that case, FOB shipping point was a strategic decision. So companies fight about this more than you think. Freight. Merchandise was purchased on account for $400 plus freight. So purchases is debited only for the cost of the merchandise. Just like sales is always credited just for the selling price of the merchandise, okay? Purchases, sales, the same exact thing. Freight in is debited for the transportation costs. So we debit purchases for 400. We have to pay the freight bill. Accounts payable for 38, okay? And all they're showing you here is you might not get the freight charge directly from the vendor. You might get it from the freight company. It just means you have to pay two different people. So you debit purchases for 400 and you credit accounts payable. And then you get the bill from Red Ball Freight and you debit $38 freight expense, credit AP, okay? Now, here we go. You're going to see a little bigger income statement coming up, huh? Computation of gross profit. Let's understand what gross profit is. Net sales minus cost of goods sold. Net sales minus cost of goods sold equals gross profit. Now, what is cost of goods sold? Cost of goods sold is simply the amount of money you paid for the product you are now selling. You purchased a garment from the wholesaler for $300, and then you sold that garment for $1,000. Well, your sale would be $1,000. The $300 that you paid for that garment is the cost of goods sold, okay? Cost of goods sold is an expense, just one expense, what you paid for your merchandise that you sold. So net sales minus cost of goods sold equals what we're going to call gross profit, okay? Wow, they want us to compute the gross profit. Got a lot of things to look at here, huh? We have sales, and we have sales returns and allowances and discounts. We have purchases with the commensurate purchase discounts. Looks like there's some freight. And they're giving us a beginning and an ending inventory because we need that to compute the gross profit. So, computing the gross profit. Let's do it step by step, slowly, and peel the onion back. First step, compute net sales. We know how to do that now. Net sales. Sales minus your sales returns and allowances, minus your sales discounts, minus any credit card fees. That'll get you down to net sales. So that's step one. Next step, we're going to compute something called goods available for sale. That's your beginning inventory balance plus the cost of goods purchased. The beginning inventory, you had $10,000. You purchased $90,000 worth of stuff during the month. 90 and 10, that's 100,000 available. That's the most you could have sold that month. 100,000, that's what was available. At the end of the month, we're going to count the inventory and figure out what we sold, what we didn't. But the goods available is your beginning inventory plus the goods purchased. And you're going to be seeing that a lot for the rest of the class. This is the cost of all the goods that were offered for sale, okay? Step one, net sales. Step two, available. Step three, compute the cost of goods sold, okay? When you know what the goods available for sale are, You then subtract the ending inventory from that, and that becomes your cost of goods sold. In this example here, they had $129,500 worth of merchandise available, huh? I just want to see something here. Okay, they're not really following the numbers from there. Okay, out of 129,500 of merchandise available to sell, 18 was not sold. We counted the inventory. We physically have to do that under this periodic method. So our cost of goods sold was 129.5 minus 18, or 111,500. Another way to make the point is what's available, the 129,500, at the end of the month, we either sold it or we still have it. Well, we have to account for 129.5. Well, we have 18 still here. We're assuming the 111.5 is what was sold, the cost of goods sold. And then you just subtract that number from the net sales, okay? There we go. Let's take a peek at this, huh? This is interesting, huh? Here is an example of an income statement under GAAP laws, huh? Sales, gross sales, we could call that. Gross sales minus sales returns and allowances minus sales discounts equal net sales. That was step one. Step one, get the net sales. Step two was to get the available number. You remember that? The available number. Well, what's available? The beginning inventory plus your purchases minus any contra accounts like purchase returns and purchase discounts. Gives you something you might call net purchases. We have to add in any freight. So the cost of the purchases was 103. 26,000 plus 103,500. Available. They had 18,000 left in the ending inventory. So that means the cost of goods sold is 111.5 and your gross profit is 87.8, which is the 199,300 net sales minus the $111,500. So this is a longer financial statement to put together to understand. You're going to be seeing this a lot. Net sales minus cost of goods sold equals gross profit. And then from that, we're going to subtract our operating expenses to get net profit. The accounts payable ledger. Well, this you should be able to knock out of the park because you're pretty good with posting to the ledger, I think now. Accounts payable ledger, subsidiary. Remember we had the accounts receivable ledger, which was the subsidiary for the control account accounts receivable. Here we've got the reciprocal. We've got an accounts payable ledger. It contains an individual account for each supplier. Just like in your general ledger, you have one account for cash, one account for accounts receivable, one account for accounts payable. Now we're taking that accounts payable number in the general ledger and showing the detail by vendor. So subsidiary ledger, usually alphabetically listed. Summary accounts payable account, that's the control account. So let's see what we have here. We have some purchases, purchase merchandise from Blinky, terms 115, dated. Looks like all of these are simple purchases. I don't see any sales tax. I don't see them talking about any returns or anything. So let's take a look. Blinky Cycle Works, $3,300, huh? Ellsworth, $2,500. Well, here's your journal entries. You debit purchases and you credit accounts payable, 33, 25, etc., etc. Post to the general ledger. In the general ledger, as you know, you enter the date, the amount, and then you're going to come up with a new balance. Enter the journal page number if necessary. In the journal, enter the ledger account number in the PR post-reference column. But let's take a peek at it. Here's your general ledger. Purchases were 3,300. I see 3,300. 2,500 purchases, I see that. And I see the two credits to accounts payable right here. 3,300, 2,500 with the new balance. So that's just a simple look at the general ledger. Now we're going to do the same thing. We're going to post to the accounts payable ledger, only this time, instead of one number for accounts payable, we're going to have the detail ready for us. So take a peek. Over here, we just looked at this. Here is your accounts payable ledger. And what happened was Belinsky bought 3,300 credit. That's the balance that they owe. 2,500, no beginning balance, 2,500, okay? The accounts payable ledger shows all the activity by vendor. Posting purchase returns, it's not too tough. Assume on May 4th that Sunflower returned $200 worth of merchandise. And they were part of a purchase on April 23rd. And the debit for $200 is going to be posted to accounts payable, to the control account, as well as the subsidiary. Purchase returns and allowances is posted in the normal manner. So let's see what we're talking about. Here is our journal entry. We returned $200 worth of goods. So we get to debit accounts payable for $200 and credit purchase returns. And they're showing you the debit here in the general ledger and the credit in the general ledger. And if you look here, you're going to see accounts payable ledger, and then you're going to have a folder for each associate. So here, Rand's Design, 5,300 plus 200, 5,100 or 200 less because it was a return. So I think you're pretty good at posting to the ledger, posting cash payments. Now we paid somebody. We paid $4,800. There was no discount involved. So we debit 4,800 and we credit cash. We paid Gunnar $8,700 less a discount. So we get the debit or zero out accounts payable, 8,700. The discount is $87, which means the cash output is 8613. 8613. And again, they're showing you the posting to the various ledgers. Now we're just about done with the accounts payable cycle. Now we're going to prepare the schedule of AP, just like we did the schedule of accounts receivable. And this is just going to be an alphabetical listing of all the people to whom you owe money. And it's prepared to verify that the sum of the accounts payable ledger equals the accounts payable balance. Typically alphabetical order. You prepare it at the end of the month. And again, the total of all these vendors, all these sellers better equal the total in your accounts payable. And it looks like they just have 4 people: Belinsky, Ellsworth, Milwaukee Cycle, and Rand's Design. It adds up to $11,900. The auditors, again, they're going to come into your building. They're going to say, how much do you owe to your vendors at the end of the month? And you say $11,900. And then the auditors are going to say, show me who owes you the money. You would provide this to them. And then the auditors would decide what to do with this. They'll probably contact 3 or 4 of these people and verify that these numbers are correct. Again, I'm not going over finding accounts payable errors. And that is the end of our lecture today. Okay, so chapter 10, chapter 11 are pretty much related. And when we get into chapter, now we're going to skip chapter 12. We don't teach chapter 12. And then we're going to go 13, 14, 15, which builds on what we were talking about the last 2 classes. Anybody have any questions, any comments?
No, Professor.
You okay? You okay there, Mark?
Yes, sir.
Okay. You all right, Rhea? No questions?
Feeling good. Thank you so much.
Okay. Have a good weekend, guys. Okay.
You too. Bye.
Bye-bye.
Bye. Thank you, Professor.
You're welcome. Bye-bye, Mark.